Millions of Canadians are paying more in taxes each year than they really should, as the CRA isn't going to let you in on the possible tax deductions and strategies that would mean less money in their pockets. So it's up to you to make sure that you're covering all of your bases this tax season to legally pay as little tax as possible and get the most out of your tax return. In 2024, 18.9 million Canadians received a tax refund, accounting for over $43 billion in total returns. So let's make that amount even larger this tax season. The Canadian government splits income into a variety of different categories, each with distinct characteristics, tax treatments, and implications for financial planning. So understanding these categories is really key to maximizing tax efficiency and planning your financial future in the short and longer term. Let's dig into each one a little bit more. Employment income, also referred to as T4 income, since that's the slip that's used to report it on your tax return, is the most common type of income for most working Canadians, including wages, salaries, bonuses, commissions, and other forms of remuneration paid by an employer. Now, generally speaking, employers will deduct income taxes, CPP contributions, and other governmental fees from your employment income before it even hits your bank account, which is why at the end of the year, after applying various deductions and credits, most Canadians will actually receive a tax return for the excess between what they paid throughout the year and what they truly owe. For example, if you paid $25,000 in income taxes throughout the year, taken directly off of your bi-weekly paychecks, well, you may very well be able to receive a tax return if you're able to claim credits and deductions that we'll be discussing in today's video, bringing down your tax owing to say $22,000. In this case, you get back $3,000. That being said, keep in mind that employment income is among the highest taxed forms of income in Canada and offers very limited tax deductions to allow for a reduction of taxable income and therefore taxes owed. Now, it's important to understand that Canadian income is taxed using a progressive marginal tax system, meaning that different portions of your income is going to be taxed at increasing rates as your income rises through these echelons. And this system is meant to ensure that higher earners pay proportionately more in taxes, but only the income within each tax bracket is taxed at that corresponding rate. So here's how that works in practice. Your income is divided into tax brackets, and each bracket has a specific tax rate, where these rates apply incrementally as income crosses each one of these thresholds. For example, if you earned $100,000, well, for your federal taxes, you will pay a 20.5% tax rate on the income between $55,867 and that $100,000, meaning $9,047 in federal taxes. And from here, the average rate of tax that you pay on your total income is known as your effective tax rate, which will be lower than your marginal tax rate because only portions of your income are taxed at the highest rate. So here are what the federal marginal tax rates look like in 2024, and depending on the province that you live in, the provincial marginal tax rates will differ depending on that province, but you can easily find these rates online. Now, from the income that you'll earn this year, the main way you can start reducing your tax bill or increasing your refund is through the use of a variety of tax deductions and credits. So it's very important to understand that tax deductions don't actually directly reduce your taxes, but rather they reduce your actual taxable income, meaning you only pay tax on a smaller portion now of your income, which, if done correctly and strategically, could reduce your taxable income down to a lower marginal tax bracket even. For example, if you earn $70,000, well, for each dollar in tax deductions within that current bracket, you're paying 20.5% less in federal income tax. And if you're able to bring your taxable income down into the lower tax bracket, you'll be paying significantly less in tax because each dollar earned in that bracket is only taxed at 15% federally. On the other hand, a tax credit is an amount that reduces the taxes you owe directly lowering your tax bill on a dollar for dollar basis, where unlike tax deductions, which reduce your taxable income, tax credits apply to the actual taxes calculated on that income. And these come in two forms: refundable and non-refundable tax credits. Non-refundable tax credits can reduce your tax payable to zero, but won't result in a refund if they exceed your tax liability. For example, the basic personal amount, but you can't use this tax credit to create a refund. Refundable tax credits, on the other hand, can result in a refund if the credit amount exceeds the taxes you owe. For example, the GST/HST credit or the Canada Workers Benefit. So overall, tax credits make a significant difference by directly reducing your tax burden, with refundable credits often offering additional benefits for lower income earners. And not to worry, we'll cover a bunch of tax deductions and credits that you can use on your return later in the video. Okay, now that you understand the basis of how taxes work in Canada, let's discuss ways to reduce your tax bill, starting with registered investment accounts. Registered investment accounts are one of the low-hanging fruits offered by the Government of Canada to reduce your taxable income or offset taxes paid on your investment income, which tends to be favorably taxed itself. The first registered account we'll be talking about is called the Group RRSP, which is a retirement savings plan offered by certain employers to their employees, where contributions are made through payroll deductions and invested to grow tax deferred until retirement. And employers often match a portion of employee contributions, making it a valuable workplace benefit. Some of the benefits of a group RRSP include the following. Contributions are deducted before taxes, reducing taxable income immediately. Employer matching, which can significantly boost your savings with effectively free money offered from your employer. Oftentimes, you can also opt for automatic payroll deductions for these contributions, which makes saving easy and convenient. And finally, tax-deferred growth, where investments within the group RRSP grow without being taxed until withdrawn years down the line. So overall, if your employer offers it, a group RRSP is an excellent tool for building retirement savings efficiently, taking advantage of employer contributions and tax deduction benefits in the year of contributions. Now, if your workplace doesn't offer a matching group RRSP option, the next best thing would be to take things into your own hands with a traditional RRSP, which is an investment account designed to help Canadians save for retirement, where contributions are tax deductible and the investments grow tax deferred until withdrawn as well, typically in retirement when your income may be lower and in a lower tax bracket. Some of the benefits of an RRSP include the following. Tax savings, of course, as contributions to an RRSP are tax deductible, reduce your taxable income, and lowering your taxes for the year. Investments inside an RRSP also grow tax-free until withdrawn. And finally, the ability to leverage your RRSP prematurely using the first-time home buyers plan, allowing for tax-free withdrawals for a down payment on your first home of up to $60,000 from your RRSP, which is highly advantageous considering the current state of the Canadian housing market. And as an example of how this works as a tax deductions, let's say your taxable income is $60,000 for the year. Well, a $5,000 RRSP contribution would bring your taxable income down to $55,000, saving you roughly $1,400 in tax as an Ontario resident. Another tax-efficient strategy to leverage in your RRSP if you have a spouse is called spousal income splitting, where if you or your spouse has a much higher income than the other, contributions are made by the higher income spouse to an RRSP in the name of the lower income spouse, allowing the contributor to receive an immediate tax deduction at their higher marginal tax rate. And when funds are withdrawn in retirement, they are taxed in the hands of the lower income spouse, potentially at a lower tax rate, reducing the couple's overall tax burden. The next registered investment account to take advantage of if you're saving and investing towards the purchase of a home would be the First Home Savings Account, or FHSA for short, which combines the benefits of a tax-free savings account, or TFSA, and a registered retirement savings plan, RRSP, allowing contributions to grow tax-free and withdrawals for a home purchase to be non-taxable. taxable. It's sort of the best of both worlds here. Some of the benefits of the FHSA include the following. Contributions to the account reduce your taxable income in the same way an RRSP does. It also grows tax-free as investments inside the FHSA are not subject to tax. Making it even better, withdrawals are also tax-free as funds used for a qualifying first home purchase are completely free of tax. So overall, the FHSA is an excellent tool for first-time homebuyers to save efficiently while enjoying significant tax advantages in the process of saving for a first home that you should definitely take advantage of if you're in this situation. And finally, for the registered investment accounts, the TFSA is also an excellent tool for growing your net worth while reducing your tax burden down the line. This is because contributions to a TFSA grow tax-free, meaning any interest, dividends, or capital gains earned inside the account are not subject to taxation, even when you withdraw the funds. So unlike RRSPs, a TFSA withdrawal doesn't count as taxable income, which can help you avoid being pushed into a higher tax bracket. Plus, the contribution room is restored in the following year after a withdrawal, offering flexibility and long-term benefits. So it's for these reasons that the TFSA has become one of the most popular investment accounts in Canada. And by the way, if you want to learn more about the TFSA, the FHSA, and other investment accounts, I've made a bunch of videos for you to check out on the channel after this one. Hey, a quick moment here to speak about today's video sponsor, moomoo, that integrates incredibly well with today's video, speaking about tax-efficient Canadian investment accounts, and is highly relevant in saving money on FX fees, which is a big deal considering where the CAD to USD exchange rate is right now. Now, there are many options to choose from when considering Canadian brokerages, but if you're looking for an all-in-one platform that offers low fees, but also an incredible amount of stock and company research functionality built right into the platform free of charge, I'd suggest you look into moomoo for opening a TFSA and your RRSP. If you invest in US stocks, which you absolutely can hold in registered Canadian investment accounts, moomoo can help you save up to 90% on trading costs due to their highly competitive trading fees, charging literally less than 1 cent per share for US stocks and ETFs, with a minimum fee of about $1.99, which is much lower than the $9.99 charged by many other brokerages. Additionally, another feature that I absolutely love is that moomoo offers the lowest currency exchange rate I've ever seen in Canada at only 0.09% plus $2. So for example, if you're converting 10,000 Canadian dollars, the currency conversion fee would be a mere $11, while other brokerages would easily charge upwards of $200 for that same conversion. So we're talking a fraction of the cost using moomoo over other banks and brokerages. Another reason why moomoo is a great option is because it's the only brokerage in Canada offering free real-time level 2 market quotes for US and Canadian stocks, a service that can easily cost up to $90 Canadian elsewhere. So this means over 150 analytical tools, advanced charting, and money flow data helping you evaluate stocks effectively. So make sure to open up a TFSA or RRSP with moomoo today using my exclusive link down below in this video's description, where when doing so, you'll receive a $2,000 commission card, as well as if you deposit $100, you will receive $50 in stock cash coupons and a $30 Amazon gift card. Or if you deposit $2,000, you can earn $200 in stock cash coupons, above the fact that on your deposits, you'll receive a 6% APY cash rebate and up to $2,200 in total rewards. All right, moving away from the registered investment accounts, one of the ways that you can start unlocking tax deductions on a wider scale is through earning self-employment income. So from a business that you're operating, as self-employment income in Canada comes with several tax benefits that can significantly reduce your tax burden. Essentially, as a self-employed individual, you can claim a wide range of business expenses as deductions, which again reduce your taxable income, including things such as home office costs, vehicle expenses, internet and phone bills, travel, meals for business purposes, and so on. Additionally, you have a higher degree of control over your income reporting, allowing for more strategic tax planning and the use of deductions. For instance, you can time your expenses and income to optimize your tax position each year. Things just get more granular and controlled. By the way, if you're earning self-employment income at the personal level without flowing that income through a corporation, take note that you report this income and any deductions from it on a T2125 tax form at the same time as the rest of your taxes by April 30th each year. Overall though, by taking advantage of these tax benefits, self-employed individuals, or even if you just have a side hustle generating a bit of extra income on the side to supplement your employment income, are now able to start deducting business expenses from your total income and can enjoy greater financial flexibility, as business expenses for your self-employment income can actually come and even offset the income that you're earning from your job. That's something millions of Canadians take advantage of each year. For example, if you earn $60,000 from your job this year on your T4 slip and made an extra 10 grand from, say, selling t-shirts online, but your expenses for the year were $12,000 because you're still setting up the business, which cost a lot of money, well, that $2,000 loss could actually come and reduce your taxable income from your job. Now, there are way too many business tax deductions to fully cover in this video, but if you do run a business, here is a comprehensive list of the deductions that you could consider when filing your tax return. So take note, and if they apply to your business, make sure you don't forget them. What about if you don't earn any self-employment income though? Well, there are significantly less deductions that you can take advantage of to offset income from your job, but there are still a few that you may be able to claim. Here's a list. Alimony payments are tax deductible for the payer and taxable income for the recipient, provided they meet specific conditions outlined by the CRA. The childcare expense deduction also allows eligible taxpayers to deduct up to $8,000 per eligible child under 7 years old and $6,000 per child under 16 years old for childcare costs incurred to earn income, attend school, or engage in job training. Moving expenses can also be a tax deduction where you can claim moving expenses that you paid in the year if both of the following apply. You move to a new home to work or to run a business out of a new location, or you move to be a student in full-time attendance in a post-secondary program at a university, college, or other educational institution. And finally, interest that you pay on money used to generate income and for investment purposes may be deductible if it meets the CRA's criteria. For example, if you use a line of credit to invest in a rental property, well, the interest that you're paying on that line of credit can generally be deducted to reduce taxable income. This is something all business owners leverage. Now, what about tax credits that can be used to directly reduce your tax burden this upcoming season? Here are a few to keep in mind. The charitable tax credit allows you to receive a tax credit of 15% of the first $200 you donate, and for donations over $200, the federal tax credit rate increases to 29%. Plus, you may also be eligible for a provincial tax credit depending on where you live. The disability tax credit is a non-refundable tax credit of up to $9,400 in 2023, designed to reduce the income tax burden for individuals with a severe and prolonged physical or mental impairment, or their supporting family members. The tuition tax credit allows students to reduce their taxable income, where the tax credit will equal the tuition paid multiplied by an appropriate percentage, which at this time is 15%. So for example, if a student paid $8,000 in eligible tuition fees during the year, they could potentially claim a $1,200 tax credit. And note that a student must use the tuition tax credit to reduce their tax payable to zero. Any excess amount can be carried forward to be applied against the student's tax payable in future periods. From here, the student loan tax credit allows you to receive a 15% tax credit on any interest that you pay on your government student loans each year. This credit applies to interest payments you make on both your federal and provincial or territorial student loans. Next up, the home buyer's amount in Canada is a non-refundable tax credit credit of up to $1,500 for eligible first-time homebuyers who purchase a qualifying home, helping to offset costs associated with the purchase. So don't miss out on this one if you bought a house this year, because you can't claim it in future years. The medical expense tax credit is a non-refundable tax credit that you can use to reduce your tax that you paid or may have to pay. So if you paid for healthcare expenses, you may be able to claim them as eligible medical expenses on your tax return. These expenses include a wide range of products, procedures, and services such as medical supplies, dental care, and travel expenses, although the amount that you can claim is only the excess between what you paid and 3% of your income. So that's a little list of some common tax credits and deductions you can claim on your tax return. And if you want to learn more about these, make sure to check out my full video on the channel. All right, now if you do own a house, unfortunately, you cannot deduct the interest that you're paying on your mortgage from your income, like down in the United States. However, one strategy that's been developed to still take advantage of interest deductions from your dormant equity in your home is called the Smith Maneuver. So the Smith Maneuver is a financial strategy in Canada that allows homeowners to convert their interest on their mortgage into a tax-deductible expense by leveraging a readvanceable mortgage. And this is achieved by using home equity gained through mortgage payments to invest in income-generating assets like stocks, ETFs, and other investments, and then claiming the interest on the borrowed amount as a deduction on your taxes. This strategy is typically used by individuals with more stable income, a higher risk tolerance, and a long-term investment horizon, as it combines debt management with investment growth. And if you're wondering, yes, I've been using this strategy for a couple of years now, leveraging the equity in my principal residence here to invest in my real estate business, where interest then becomes tax deductible because I'm using it to invest. Now, there are a few considerations that need to be made before attempting to use the Smith Maneuver, but it's one of the only ways to somewhat deduct interest from the mortgage payments on your personal residence in Canada. So if you think this may be right for you, I'd highly recommend that you speak with your accountant and maybe even a CFA for a consultation to make sure that it fits within your financial strategy. And you'll also need to go out and acquire a readvanceable home equity line of credit. Speaking of property ownership, although not everyone is willing to or can afford to purchase rental real estate, this is one of the best ways to reduce your overall tax burden, as expenses and losses can offset your personal income even. The idea here is that owning real estate in Canada offers numerous financial and tax advantages, making it one of the most powerful tools for building wealth and securing financial stability. So one of the greatest benefits is that capital gains on your primary residence are tax-free, allowing you to build equity and profit from appreciation without any tax implications when you sell down the line. Now, for those venturing into rental properties, the benefits are even more compelling. You can deduct all related expenses, renovation costs, and interest payments, significantly reducing your taxable income. Additionally, if your rental property incurs losses due to high expenses or renovations to increase the value, these losses can offset your active income, effectively lowering your overall tax burden, a strategy many investors, including myself, use while improving their properties and increasing their value. You can also depreciate the property over time, further reducing taxes owed, particularly useful when your taxable rental income is moderate to high. Another key advantage is the ability to refinance properties, allowing owners to access capital without having to pay capital gains tax. So unlike a sale where capital gains taxes apply, refinancing allows you to unlock your property's equity tax-free. These funds can then be reinvested, multiplying your investment opportunities while deferring tax liabilities. Overall, real estate is not just an asset, but a versatile financial instrument, offering both short-term tax benefits and long-term wealth building potential, which is one of the reasons why it's helped many Canadians grow their wealth over time. And when managed strategically, it can provide consistent cash flow, tax efficiency, appreciation, and other opportunities. To summarize, while Canada's tax code offers numerous opportunities to reduce your taxable income through deductions, credits, and strategic financial planning, it's designed to ensure a baseline level of tax compliance, particularly for higher earners. Achieving Achieving a zero or negative tax balance is challenging due to safeguards like the minimum income tax threshold, which ensures everyone contributes a fair share. Even with significant deductions such as those from a real estate business or other investments, some tax liability often remains, as was the case in 2024 when I managed to offset the majority of my income actually, but still paid a modest amount in taxes due to hitting those minimum income tax levels, which I think is ridiculous, but those are the rules the CRA is always going to collect. But this highlights the importance of understanding tax regulations and leveraging them strategically to optimize your financial situation while recognizing the inherent limits set by the system. So I really hope you enjoyed today's video. Make sure to check out my other tax planning and filing videos on the channel. They're sure to help you out. If you enjoyed today's video, make sure to drop a like and consider subscribing to this channel for more personal finance and investing content. I'd also recommend you check out the links down below in today's video description and pinned comment for useful links and resources that I recommend. Thanks for watching, and I'll see you in the next one.